Typically, when you look at high-yield ETFs such as TSLY, they promise big returns. However, these ETFs often suffer significant price declines, reducing your overall investment value despite the high cash flow. Additionally, their dividends can be quite unpredictable. Take the JP Morgan Premium Income ETF, or JEPI, as an example. Its monthly dividend has fluctuated dramatically from about 61 cents to between 29 and 36 cents in recent times. While these amounts might not seem terrible for a $50 ETF, the inconsistency can be disconcerting for investors. In this video, we'll look at a high-yield ETF that's different from the others. It doesn't have the usual negatives, but keeps the good parts. Want to know more about a great high-yield ETF? Stay with us, hit like, and share your favorite dividend ETF in the comments. Plus, I'll explain at the end how this ETF could potentially replace your day job. Today, we're looking at the Simplify Volatility Premium ETF, or SVOL. This ETF is a big game changer in the investment world. Its goal is to move inversely to the VIX Volatility Index, but not fully. It aims for a 20 to 30% inverse correlation. This strategy is perfect for those who are searching for income opportunities in today's environment where traditional sources aren't yielding much. SVOL kicked off in May 2021 and has already gathered assets worth over $581 million. Despite its novelty, it's made a mark with a unique approach to income generation. The expense ratio stands at 1.16%, and the fund distributes income monthly. Plus, for those interested in options trading, SVOL provides that flexibility. What makes SVOL stand out is its strategy. It mainly takes a short position in the VIX futures, capitalizing on the volatility market. To balance the risks, there's a small allocation for VIX call options, serving as a safety net against potential volatility spikes. As of late 2023, the net asset value, NAV, per share was around $22.76, closely matched by its market price. This reflects a stable and consistent valuation. The fund also maintains a tight 0.04% median bid-ask spread, which is great for liquidity. In terms of performance, since its inception, SVOL has shown an impressive growth of about 32%. But here's a word of caution. Being an actively managed fund that's relatively new, it comes with its unique set of risks. These include the inherent risk in derivative instruments and the unpredictable nature of VIX futures. So it's crucial for potential investors to understand these aspects thoroughly before diving in. In conclusion, SVOL offers a novel approach for those looking to diversify their income sources in the current economic climate. It's a blend of innovation, risk management, and potential for growth. But, as always, careful consideration and understanding of the risks are key before making any investment decisions. Remember, investing always involves risks, and it's important to do your own research or consult with a financial advisor before making investment decisions. Let's dive into how much you could earn from a $10,000 investment in this ETF over time. To calculate the potential returns on a $10,000 investment in the Simplify Volatility Premium ETF, SVOL, over different time periods, we need to use its historical performance as a reference. However, it's important to note that past performance is not indicative of future results. For this calculation, I use the following data: share price of $22.78, initial annual dividend yield 16.33%, expected annual dividend amount increase percentage per year 3%, and expected annual share price appreciation percent per year of 3%. All right, let's talk about how your investment could shape up over time. Imagine this. Just after a year, your investment could balloon to around $12,034, plus you'd pocket about $2,119 in dividends. Pretty neat, right? Fast forward 5 years, and you're looking at your investment potentially hitting $25,464. And the cherry on top, a cool $4,484 in dividends for that year alone. Double that time frame to 10 years, and things get even more interesting. Your investment could soar to roughly $64,989, with annual dividends reaching an impressive $11,444. Now, let's think long-term. In 20 years, you could be sitting on a massive $423,303. And those yearly dividends? A whopping $74,541. Now, these are hypothetical scenarios, of course, but they sure paint an exciting picture of what might happen with your investments. Okay, we'll compare SVOL, a newer ETF, with the long-standing S&P 500 SPY across different timeframes. Remember, SVOL hasn't been around long, so data is limited. When encountering new ETFs or stocks with unique strategies, I start with a few shares, see their performance in my portfolio, and research more over time. I've been gradually increasing my SVOL shares, especially on red days. Looking at the numbers, over 1 year, SVOL is up 26.55%, including dividends and price return. This performance is impressive, considering that the S&P 500 returned 16.81% in the same period. Beating the S&P 500 long-term is tough, especially for new investors. However, unlike the S&P 500, SVOL offers a significant dividend, which is appealing for those seeking consistent cash flow or nearing retirement. Currently, SVOL makes up less than 1% of my portfolio, but I plan to continue adding shares. Interestingly, year-to-date performance for both SVOL and the S&P 500 is almost identical, around 21%. While comparing SVOL to the S&P 500 is like comparing apples to oranges, it's still useful to see their performance side by side. Let's dive into Simplify Volatility Premium ETF risks. The Simplify Volatility Premium ETF presents an interesting case in terms of risk assessment. In investment, risk is generally expected to correlate with reward. The standard deviation is a key metric, measuring how much an ETF's returns deviate from its average return. This metric highlights the ETF's recent volatility but doesn't delve into specific factors influencing this volatility, such as portfolio concentration or foreign investment exposure. Two important indices for understanding ETF risks are the Total Risk Index and the Category Risk Index. The Total Risk Index compares the volatility of the ETF against the volatility of all ETFs, offering a broad perspective. Ratios above 1.00 suggest higher than average risk. The Simplify Volatility Premium ETF stands out with a total risk index of 0.00, attributed to its standard deviation of 0.0%. The Category Risk Index, on the other hand, measures an ETF's volatility against the average volatility of ETFs in the same category. The Simplify Volatility Premium ETF also shows a category risk of 0.00, earning a category risk grade of an A. This grading system typically ranges from A to F, based on relative rankings. These metrics indicate a unique risk profile for the Simplify Volatility Premium ETF, potentially making it an outlier in traditional risk assessment models. In summary, SVOL, or the Simplify Volatility Premium ETF, has been a recent addition to my portfolio. It's not perfect for every investor, but if you value cash flow, it's worth considering. I'll keep adding it to my portfolio. I'm curious to hear your thoughts. Would you add the SVOL ETF to your portfolio? Drop a comment with a yes or no and share your reasons. If you like this video, please like and subscribe for more content like this. Thanks for watching, and check out my other investing videos here.